Hey, welcome back to Compounding Quietly. Most investors pick the higher yield and call it a decision. That's not a decision, that's a default. When you see JEPI and DIVO side by side, the yield gap looks like a conclusion. But the question that actually matters is not which one pays more today. It is which structure fits where you actually are. Let's think through this together. There's a moment many income investors recognize. You see JEPI's yield somewhere between 7 and 9%. And the math suddenly starts to feel achievable. You run a quick number: if I had enough of this, the monthly income would cover what I need. That thought is not wrong, but the decision that often follows it is, because at that moment, most investors are comparing yields. They are not comparing structures. And structure is where JEPI and DIVO become genuinely different from each other. The natural instinct when comparing two income ETFs is to treat yield as the scorecard. Higher yield means more income. More income means the goal is closer. So the choice feels obvious. That logic is clean, and it is incomplete. Yield tells you what you are receiving today. It does not tell you what you will be receiving in 5 or 10 years. It does not tell you whether that income will grow, compress, or plateau. And it says nothing about the conditions under which that yield was generated. JEPI, the JP Morgan Equity Premium Income ETF, holds a defensive equity portfolio. It generates additional monthly income by selling covered call options on the S&P 500 index. That options overlay is what produces the high headline yield. In periods of elevated market volatility or sideways price action, covered call premiums are high and distributions follow. When markets rise sharply, JEPI participates, but only up to a point. The sold options collect the upside instead of the portfolio. Income is generated. Growth potential is capped. DIVO, the Amplify CWS Enhanced Dividend Income ETF, is built differently. It holds a concentrated portfolio of high-quality, dividend-paying companies and applies covered calls selectively to individual positions. Income comes from two sources: the dividends those companies pay and targeted premiums from selective call writing. Because the covered calls are tactical rather than systematic, DIVO retains more upside participation when its holdings move higher. The trade-off is a lower headline yield, typically in the 4 to 5% range, compared to JEPI's 7 to 9%. On a comparison screen, JEPI looks like the winner, but yield is not the same as income quality. Income quality is what determines whether your portfolio still works for you 10 years from now. Here is the judgment criterion that actually clarifies this comparison. Are you in the phase where you need income to live on today? Or are you in the phase where you are building income for later? That question is the real dividing line between these two funds, not the yield gap. If you are in distribution phase, if your portfolio is already your primary income source, then high current yield has direct, practical value. Every percentage point of monthly distribution is income. You do not need to generate by selling shares. Selling shares in a down market to cover monthly expenses is one of the most structurally damaging things a retirement portfolio can do. JEPI's higher yield in that context is not just a number. It is a buffer between your income floor and a forced selling decision. That is a real structural advantage. But there is a limit to that argument. JEPI's income is variable by design. When covered call premiums are elevated in volatile or declining markets, distributions are strong. When premiums compress in calm, steadily rising markets, distributions shrink. That variability can be substantial across a full market cycle. Consider a specific scenario. You retire and build your monthly spending plan around JEPI's 8% distribution. 2 years later, the market enters a low volatility uptrend. Premiums compress. Your distribution falls to 5.5%, then closer to 5%. You have not lost principal, but you are receiving meaningfully less than your plan assumed. For some retirees, that variability is manageable. For others, especially in the early years of retirement, when confidence in the portfolio is still being formed, the income drop is disorienting. It creates a quiet anxiety that pushes investors to question their strategy, even when the structure hasn't actually failed. The expectation didn't hold. That gap is where poor decisions get made. DIVO approaches the same problem differently. Its underlying holdings companies, with long records of growing their dividends through multiple market cycles, provide a base income that tends to increase over time. The selective covered call strategy adds income on top of that base, without systematically capping the portfolio's recovery potential. When the market rebounds strongly, DIVO doesn't give away that recovery the way JEPI does. The result is lower current income, but a more stable and growing income path. Now revisit the question the title raises. Income now or income that grows? For an investor in accumulation, phase someone a decade or more from needing distributions. DIVO's structure fits more naturally. A 4.5% yield, growing at 6 to 8% annually, compounds faster than most investors expect. Over 10 years, on your original cost basis, that yield could realistically reach 8 or 9%. At that point, DIVO has become the higher-yielding position in your portfolio, without a strategy change, without additional complexity. JEPI, if distributions remain flat or variable across the same decade, will not have moved in the same direction. The math does not always favor the higher starting yield. It favors the structure that matches the time horizon you actually have. There is also a total return dimension worth naming directly. JEPI's index-level covered call overlay cushions some downside, but it also limits recovery participation. In a sharp market rebound, JEPI tends to trail. The options it sold are collecting the upside instead. For a long-term accumulator, missing recovery upside compounds over time. The gap in terminal value is real, even when it is invisible in any single year. DIVO, with its selective approach, participates more fully in recoveries. For a distribution phase investor, that trade-off is more acceptable. You are drawing from the portfolio, not compounding it. Smoothing the volatility is a reasonable trade, when income stability is the actual priority. So here is where each of these funds earns its place, and where each one doesn't. JEPI earns its place in a distribution phase portfolio, where current income is the immediate need and where the investor understands and accepts monthly variability. The income arrives consistently enough to plan around, even if the exact amount shifts with market conditions. DIVO earns its place in an accumulation phase portfolio, where dividend growth over time is the objective. A lower starting yield is acceptable there, because there is time for it to compound. The mistake in this comparison is not picking the wrong ETF. The mistake is picking based on headline yield, without first being clear about which phase you are in. A 9% yield sounds better than 4.5%, but if you are 15 years from retirement and you choose JEPI today, the cost is real. You may be trading a decade of compounding dividend growth for income you cannot yet use efficiently. That cost does not appear on the fund comparison page. It shows up later, when the window to build has closed. The yield number is not the decision. Your phase is the decision. Once that is clear, this comparison becomes much simpler than it looks. Compounding quietly. Slow, steady wealth building. If this helped, subscribe and leave a like. Everything here is for informational purposes only. All final decisions and responsibilities remain with you. Thanks for spending time with Compounding Quietly today.